Yeah, I guess one of the things that, myself and, a lot of advisors obviously are looking at is really how far do we expect them to continue to raise rates to kind of tame the demand? And then where do you guys see that equilibrium? Is if we get above 4, 4.5, I mean, does that become a scenario where, we're expecting the market to drop 20% or whatever it is? How do you guys think about that? I mean, are you guys charting kind of the percentage on where they're raising it to say, hey, if at this 4%, we're expecting base case of X multiple, which puts the S&P at 3,600, 3,800. How are you guys thinking about that? Are you guys trading more on the fundamentals of the market and the fact that, hey, the labor market's strong, the consumer is still strong? So I maybe unpack that a little bit, from your guys'
Yeah.
perspective.
And I think there's a combination there of how we think about things. It's fundamental and technical. The Fed has a couple levers to pull when we think about interest rates, right? How aggressive do we want the rate cuts to be? How fast do we want those to go through the system? And then how long do we keep them at a sustained level? And I think what we're seeing now is the Fed is moving more towards that latter component there. We're getting closer to what they would consider to be a restrictive level. And, they've really come out and with a full court marketing press here and basically saying it's going to be higher for longer. The fact that they're shifting a little bit away from aggressive rate hikes and large rate hikes to probably more sustained ones over the near term. And again, when I say that, I'm talking about the November, December meetings here. I think the meeting tomorrow, 75 is a foregone conclusion. But after that, if you look at what the market's pricing in for expectations when you look at interest rate forwards, it's more along the lines of a 50 and then a 25. But the point being, I think these large moves are going to be a thing of the past. And now it's going to be a question of how long are they going to stay in that restrictive zone? And the other thing I would point to, the market's discounted a lot of this. And what do I mean by that? Well, if I look out at what we call the terminal rate, right, that's sort of where we expect the rate hike cycle to stop and maintain for a little while. We're at about 4.5% right now. I would back of the envelope calculation would say roughly 4 to 4.25 would be considered restrictive. So they're slightly restrictive. And if they stay with that higher for longer mentality, we probably stay at that 4.5% for quite some time. That's enough to probably start to finally get that slowing that we're talking about. So, the one thing I would say that they're trying to do, and this goes back to sort of trying to thread that needle, they could very easily push the rates aggressively up to something north of 5, let's say. And I think that would really slam the brakes on the economy. But at that point, you're risking an overshoot and pushing us into a certain recession. I think if they don't get quite to that elevated level, but we still are in a restrictive level, and we simply use duration as opposed to absolute level, I think that increases the odds that maybe we don't slip into a very challenged and hard recession. So if we're trying to play sort of the odds, that gives us, I think, a little bit of an opportunity to let the economic data come out. Maybe we start to see it slow, and the Fed can kind of sit at that 4.5 level and let things play out, and then they can adjust accordingly. Maybe they can pull back a little bit, or if they need to go even more so, you can fine tune that. And I think that gives them a little different perspective. But to your one of your points you made at the onset of that question, there's certainly an inverse relationship between rates and valuations. And if we just plot the PE of the stock market on the U.S. 2-year yield, pretty strong relationship there, and there's still a gap opening up. So point being here, the higher those rates have to crawl, that just means the market valuation has to come down. So, I'm hoping that terminal rate stays close to that 4.5% because if it has to move up higher, the market's going to have to re-rate even more so, which means more downside pressure.